Well, thanks for having me, Tim. It's great to be here, and thanks to everyone who's joined. And I look forward to discussing some of the recent happenings with our company. If we could advance to slide 3, please. So this shows all of the Fremont acreage in the Illinois and the Appalachian Basins, totaling about 106,000 acres. You can see that the red section is Trey at 4,600. The green leases are Kentucky Exploration at 1,000 acres, and then there's the yellow MHP at about 100,000 acres. And these two basins offer an oil and gas environment that's very mature in infrastructure, low cost to operate and maintain, and in an oil and gas friendly area. So they're well suited for our strategy. Slide 4 shows our capital structure and corporate overview. And I'll let you all read the slide for yourselves, but a few items I'd like to point out here are that our market cap's on the rise, and we've got plenty of options outstanding that have a high likelihood of conversion, given the significant assets that we've recently added to the portfolio, and that certainly can provide some additional funding channels. Slide 5, please. So we hold a portfolio of 1,500 conventional oil and gas wells, and the majority of those, as I mentioned, are in the Illinois and Appalachian Basin here in the U.S. Our current production is just north of 2,000 barrels of oil equivalent per day, and we don't have any drilling obligations or anything like that. So drilling is not how we acquire and enhance production. So there's no exploration risk attached to our business. We've experienced a significant amount of growth this quarter, and that can be seen from our most recent quarterly report. Quarterly revenue this quarter was $1.73 million. Prior quarter was $257,000, so a pretty significant increase there. Receipts from customers was almost $1.9 million, 76,000 from the last quarter. And I guess one of the things that would be important to discuss here is that this only includes 1 month of production from the recently acquired MHP business. Unsold oil inventory held in the tanks up sixfold to 25,646 barrels as compared to the previous quarter of 4,540, and so at $63 WTI, this is very significant. Cash equivalents up 180% to 4.5 million. Previous was 1.63. So there's been some remarkable growth in our business as a result of some of these acquisitions, and it's a pretty exciting time for us. Slide 6. It's a graphical representation of the details provided on the previous slide, and the only thing I want to point out here is that we've diversified our commodities. Historically, we're focused primarily on oil or only on oil, and as you can see from the revenue split, we've now got oil, gas, and NGLs, and this provides kind of a smoothing effect in the eventuality of price fluctuations on a per commodity basis. Slide 7. So this represents a summary of our model to acquire, enhance, and produce. And what we're doing is we're setting ourselves apart by being an ASX listed company that grows production in this way. We're not betting the farm on drilling. It's all about building, growing and predictable revenue base. And the significant thing here is that we fill our asset portfolio with long life assets that have already experienced their declines for a steady and sustainable revenue stream. And again, there's no exploration risk. And this is a similar approach to diversified gas and oil, which has been a very, very successful company over here in the US that's deploying a similar strategy. Slide 8. So I'd like to introduce you to our MHP asset, and this acquisition is our most current one, and really has been a true game changer for FPL. And here's why. It has a substantial existing production. We started at about 8 million cubic feet of gas per day, and we've increased it to 9 million cubic feet per day using our our low-cost workover strategy. We were at 16,000 gallons of liquids, and we've increased that to 18,000 gallons. Started at 100 barrels of oil per day. We're now at 120 barrels of oil per day. So we're steadily, deploying our strategy of our low-cost workover program, and it's working. All of the production is increasing on a steady and predictable basis. And these things have already experienced their declines, and so they're providing long-term cash flow. There's also significant upside with this asset, given that it includes 1,300 wells. And 80% of the production is coming from about 25% of the wells. So there's lots of opportunity for production growth. 63% of the field remains undeveloped, and so that's a huge opportunity for the production enhancements. And as I said, we're already experiencing these production improvements through our workover program. And the other thing is that everything that is required to run and operate the business is already in place. There's 13 different long-term sales channels in place. We've got gas sales contracts with the federal government. We've got very mature oil sales contracts, and so no issue selling into the sales channels, and so that's a good thing. And again, all the equipment and gathering systems and pipelines and compression stations and so forth are already existing. And at a $425,000 acquisition price, this was non-dilutive, which is pretty substantial when you look at the impact it's had on our company. So it's really been a huge win. Slide 10 just provides a bit of an overview and a map of the MHP asset. Slide 11. So this is another asset that we acquired in late 2020 called Trey Exploration, and it's not on the same scale as the MHP asset, but the Trey assets are another great example of just the kind of assets that are perfectly aligned with our acquire, enhance, and produce strategy. And here's why. It's very similar to MHP. It has existing production. We started off at about 70 barrels of oil with Trey, and we've got it in excess of 90 now. And that's, again, steady production. It's already experienced its declines and is providing long-term cash flow for the company. Currently profitable. Lifting costs vary depending on the lease, but if you average them out, it's somewhere in the neighborhood of about $35 to $39 a barrel. And there's significant upside with this asset as well. It includes 115 wells, and 80% of the production's coming from about 30% of those wells. So there's lots of opportunity for production enhancements here too. And again, much of the field remains undeveloped. Again, everything required to run and operate and advance the business is there. The existing long-term sales channels in place, equipment, gathering systems, and so forth. So you can see the similarity, although the differences in scale between MHP and Trey Exploration. We apply the same philosophy to develop and enhance those assets in the same way, and so it's becoming a proven method for us, which is good. Slide 12, please. So this is a stratigraphic column of the Trey formations, and my intent here with this slide wasn't to provide any kind of a detailed geologic slide, but I did want to show that there are 9 different producing formations in the field, and those depths are between 1,800 and 3,000 feet, so relatively shallow, and a significant stack pay opportunity for additional production. And I'll wrap up with slide 13. Kind of indicates how we're driving value. And in summary, we're continuing to enhance the assets through that low-cost workover strategy that I pointed to basically add production and enhance our margins and improve our bottom line. And we're well funded to accomplish this. So that concludes the presentation portion. I'll turn it back over to you, Tim, for the Q&A.
Right, thank you, Tim. We've got an oil and gas analyst online, so it's quite a technical question, I think. But the question is, so to expand the group further, how will you split up growth CapEx into extending well life, appraisal step out, or even exploration?
Tim, may I ask you to repeat that question?
Yeah, sure. To expand the group further, how will you split up growth CapEx into extending well life, appraisal step out, or even exploration?
Well, exploration right now is not really in the cards. Our whole strategy is primarily to enhance existing production. And so all of the production enhancements that we're doing in the near term are all going to be CapEx to achieve our workover objectives. And we have developed 2 workover programs, one for MHP and one for Trey exploration, which we are in the process of accomplishing right now with CapEx that we've earmarked for those purposes.
And we've had previous oil and gas companies based in Canada. Are you seeing lots of opportunities because there's a lot less funding from traditional sources as the world becomes a little bit more ESG friendly?
Well, there's no question that that's true, but one of the reasons that we moved into the Appalachian and the Illinois Basin is because there's a lot of smaller operators there and lots of opportunity for consolidation. And so, in the part of the world that we're in, that's the primary reason that we're focused on those areas. And so, the MHP acquisition and the Trey acquisition, we'll prove our strategy in those acquisitions, and then look to the future.
And how are you? There's a bit of an echo there. Sorry. How are you currently funding these acquisitions?
Well, all of the we did a fundraise earlier, and so some of the acquisitions, the Trey acquisition was in part through an equity raise. The MHP acquisition was non-dilutive, as I said, and so we were well funded to develop those two assets, and what we do beyond them. As I mentioned in the presentation, there's a potential opportunity for some of our option holders to convert, and so that'll bring some additional capital into the company. But we've got a relatively solid cash base at the moment, and we're not anticipating having to go to the market anytime soon.
And there is 4 billion shares on issue. Is there any plan to kind of consolidate the share issue?
Well, that's something that is always discussed and under consideration, but we don't have a concrete plan for that at the moment.
And last question, if you don't mind. So will the future for the business be weighted more towards gas or oil? And is the US gas price going to rise more substantially?
Yeah, so we're pretty bullish on both. Certainly, the opportunity to sell a barrel of oil is a bit more attractive than to sell an MCF of gas. Just because of the difference in the commodity markets, and so we're focused on both, though, and in our case, we're fortunate enough to have the opportunity to enhance both with some of the workover programs that we've got, because a lot of the wells in MHP produce both oil and gas. To have diversification in the commodities is really important to us. As I mentioned in the presentation, we want to produce liquids, gas, and oil so that we can have that diversity.